Hey everybody, John King with Summit Funding, and here we are with my weekly Business Booster broadcast. Super excited to come to you this week. I've got a interesting topic that I want to talk about, but Business Booster is really about helping business owners, real estate agents, anybody in any related industries to grow their business. And today we're going to talk about kind of what's going on with the state of the business and specifically the mortgage industry. So let's take a brief moment and listen to kind of what Business Booster is all about. All right, now that I got my commercial out of the way, let's dive into today's topic, which is going to be Mortgage Meltdown 3.0. So before I head into that, say, hey, Kathleen, so if you guys want to get your name showed up on the screen, feel free to give me a shout out and say, hey, and I'll give you a shout out back. So Mortgage Meltdown 3.0 sounds sensationalized. Sounds like, man, John, this is clickbait. This is all the news articles that we read that gets you to click on the button, and then the substance doesn't mean anything like what you said. Well, here you go. All right, Beth knows how to get her name on the board. So thank you, Beth, for the shout out. That is absolutely a shout out. So good job on that one, Beth. All right, so what is Mortgage Meltdown 3.0? Really and truly, we are heading into a lot of stuff's been happening recently, and I want to catch you up on what does that mean and where is that going to take us? And so the first thing I want to pay attention to is, well, John, hey, if this is Mortgage Meltdown 3.0, what was 1.0 and what was 2.0? Mortgage Meltdown 1.0 was 2008. That really created major issues in the mortgage industry, and it changed the landscape of how we did things. So I'm going to spend a couple minutes explaining to you what happened there and why it's different than what's happening today. 2008, not just the recession, but literally the housing bubble and the pop of that bubble, as well as the changes in the mortgage guidelines, came because the mortgage industry tried too hard to get people qualified and to make people become homeowners, because there was a big push from the White House to increase the percentage of homeowners. And once we got everybody into homes that qualified the traditional way, we had to create expanded guidelines to keep feeding the numbers, to keep getting people into homeownership. And we created loan programs that were not sustainable. We, for years, put people into homes based upon adjustable rate mortgages that were going to skyrocket down the line, with prepayment penalties that stopped you from being able to refinance before a certain period of time without proving any of their income, without having any money for a down payment. And that created a huge bubble. And then that bubble burst. And it created a huge drop in housing prices because there was a domino effect. You had people who owned a home that could afford their payment just fine, but their payment went up because they had an adjustable rate mortgage and their equity was lower and they couldn't refinance. It created essentially a domino effect where each person that lost their home caused the next person to have to lose their home because each home was falling a little bit in value. That is not what we're dealing with today. The mortgages over the last 10 years, really since Dodd-Frank's financial reform bill went into place in 2011, all mortgages have had to be what we call qualified mortgages. Okay, so thanks, Mark. By the way, you give me a shout out, I'll give you a shout out back. So Mark, I appreciate the info. Thank you, or appreciate the shout out that you like my info. So all mortgages since 2011 have had to be qualified mortgages. That means that we had to prove somebody's ability to repay, and it proved that they had to have a low enough debt to income ratio and meet the guidelines of the federal government, Fannie Mae, Freddie Mac, FHA, and VA. We don't have a huge amount of loans for people that don't meet that criteria. Now we're starting to open up and expand guidelines. And if you've been watching me for the last year or two, I've been talking a lot about programs that have been rolling out that really started to be kind of scary. Programs like using bank statements to prove your income, programs where you're buying rental properties and we don't have to count anything but the rents on the rental property. And I'll share with you what the impact of that is today. So we are certainly getting a little bit beyond that qualified mortgage space, but nowhere near where we were in 2008. So that was our first mortgage meltdown. The mortgage world basically collapsed the global economy, and the entire weight of the federal government came down upon us and created mortgage meltdown 1.0, where half of the mortgage lenders that were in the industry, if not more than that, were no longer in the industry 2 years later. A lot of real estate agents left the industry, and it created a major change in how we did business. So that was mortgage meltdown 1.0. Mortgage meltdown 2.0 happened just 2 years and 3 months ago. So March, 4 months ago, March of 2020. COVID becomes a major problem, and the entire world shuts down March 16th of 2020. And we end up in a position where the mortgage industry was super scared. The Wall Street was super scared, not knowing, is anybody going to be able to work and pay their mortgage again? We've got a bunch of people who have been laid off, and they're not going to be able to make their mortgage payment, and the government had not yet introduced forbearance programs, and everybody worried, is anybody going to be able to buy a house? We had a shutdown where people couldn't leave their home to actually shop for a home, to buy something. Everything was done virtually and nobody knew how to do it. And the mortgage world had significant impact in a short period of time. We saw interest rates in a single day in March of 2020 go from 3.25% to 6% in a day. Now, 2 days later, they came back down to 4.5% and then back down to 3.5%. So significant volatility. But between March and May of 2020, we had more restrictions on mortgages than I've ever seen in my 22-year career. Down payment assistance programs went away because they weren't offering them anymore because they didn't know what was going to happen with the economy. Jumbo loans pretty much went away for 2 months in 2020. And unless you were doing a traditional Fannie Mae conventional loan or an FHA loan, it was super difficult in 2020, in March, April, and May of 2020 to get a loan. It really was mortgage meltdown 2.0, but it came back quickly. By May, we started to realize, hey, there's a light at the end of the tunnel. We've got forbearance programs in place, but people are still buying homes. As a matter of fact, the fact that people could work remotely actually perpetuated more home buying, combined with how low interest rates fell. So when I said we went from 3.25% to 6 and then back down to 3.5%, we quickly settled below 3% to see historic low interest rates we had never seen before. That recovery was super, super quick. So now let's get on to mortgage meltdown 3.0 and what is happening now. We're dealing with significant inflation. We've all been hearing about it for the last year. It has caused mortgage rates to go up faster than they ever have in history, with the exception of March of 2020. So I told you about March of 2020 a couple of minutes ago that we had a one-day spike from 3.5% up to 6%. Well, we went from basically 3% to 6% in 4 months. And other than that one day in March of 2020, we've never seen interest rates move up that quickly. We have the federal government responding by significantly increasing the short-term interest rate. That rate is what the federal government controls. They don't control mortgage rates. But what their goal is to slow down the economy. And they have to slow down the economy in order to slow down inflation. But in the meantime, there's been a couple of things happening in the mortgage world. First and foremost is mortgage volume has dropped significantly. Now, drop back to levels back for 2018, 2019. We're projected to have similar volume of mortgages in 2022. The problem is the industry staffed up to handle twice as much volume that we had done. We did twice as much volume, I should say, in 2021 and 2020 because interest rates were so low. So we had to staff up significantly high. Now we've got the media saying to you, oh my gosh, the mortgage industry is falling apart because they're laying people off. Here's the reality. Layoffs suck. Nobody wants to lay anybody off, but it is what happens when you have a short-term need to increase staffing, and then that need goes away. When we saw historic low interest rates that we've never ever seen, everybody wanted to refinance. The fact is, even if rates go back to 2.5% in a year or two, we're still not going to see as much demand as we did in 2020 and 2021, because there's still a large number of people who have a 2.5% interest rate. They won't need to refinance. So the meltdown that people have been talking about in the mortgage world for the last couple of months has been about layoffs and about our volume dropping. That is not the real meltdown. There's a second meltdown that people have started to talk about, and that is something recently talking about cancellations. And I saw an article the other day by Redfin that says that 15% of buyers canceled their transaction in the last month, and never highest on record percentage of people canceling their transaction. Well, any news article you got to take with a grain of salt, because the reality is, yes, 15% of people canceled their transactions, but historically 12% of buyers cancel their transactions anyway. There's a lot of reasons why somebody's going to cancel, and it's not because the housing market is crashing and the mortgage industry is melting down. It is really because of the reality of, hey, I've got contingencies that I'm looking at. The last 2 years, you haven't been able to have an inspection contingency. You wrote an offer with no contingencies. You didn't have the choice to cancel the transaction. Now people have the choice. People can take the time to have an inspection done and say, you know what, there's work that needs to be done on there and I'm not willing to do it. That is not a meltdown. That is a healthy market. Now people are saying, oh my gosh, the market's melting down because we're seeing price reductions, and 35% of homes on the market have had price reductions. Historically, 33% of homes have a price reduction. So think about this. You have 100 homes that go on the market. Of those 100 homes that go on the market, 33 of them have a price reduction. The other 67, they sell without a price reduction. But people are aggressive. People are greedy. They're going to list the price higher, hoping they can get it. They think their home is special and worth more than everybody else's home. That is not a crisis. That is not a meltdown. But here is the crisis. Here is the meltdown we're dealing with. The non-qualified mortgage space is about to disappear, in my opinion. John, what's a non-qualified mortgage? A non-qualified mortgage is a cottage industry of loan programs for people that have really high debt to income ratios. They have really low credit scores. It's kind of the new version of subprime. Now, these aren't the subprime loans of 2005. These are the new version of subprime loans that have criteria that justify some forgiveness. I think that overall, they're still good loans. Most of them are fixed interest rate loans. Most of them, we use some method of proving somebody's income. Maybe it was bank statements. We definitely had a lot of equity in those homes. So maybe I'm doing a loan for somebody that doesn't show the income on their taxes, but instead they show the income through deposits into their business bank accounts. But I won't do that loan unless you have at least 30% equity in the property. So that's not a high risk loan. But Wall Street doesn't have an appetite for them anymore. There have been 3 major mortgage companies that have imploded, that have collapsed in the last 60 days. The biggest one being just a week ago today. Literally, it's 1:43 Pacific time. It was 1:30 last Wednesday afternoon. I was actually sitting here doing this exact same broadcast a week ago when Sprout Mortgage held a Zoom call. And they told their entire company that they were shutting down effective immediately. Now, here's the backstory that nobody understands. Sprout Mortgage is the nation's largest non-QM lender. They were doing about $350 million of these loans every single month. And when they write these loans, they aren't a bank. They aren't loaning their own money. They're going to Wall Street and saying, hey, Wall Street, I've got a loan that's going to pay you on average of 9% interest, and the guy has 40% equity in the property. So there's really not much of a chance of you losing money. And Wall Street's been super happy to buy those loans. Who am I talking about on Wall Street? I'm talking about mutual funds. I'm talking about hedge funds. I'm talking about pools of money that are saying, hey, we need to get return on our investment, especially in this high inflationary environment. And they have loved these non-QM loans until last week. So what happened last week is Sprout Mortgage, actually it was about a week and a half ago that this happened, Sprout Mortgage went to market with $190 million of loans to sell to Wall Street, and they only had buyers for 90 million of them. They were stuck holding the bag of $100 million of loans. Now that's what they sell. They sell money. They take the loan and they give it to a consumer, and then they get their money back by selling it to Wall Street. They didn't have $100 million to write a check to cover those loans. They borrowed the money. This is how mortgage companies get their money. is they borrow it on what's called a warehouse line of credit. Think about it like a big old American Express card. When I fund a loan for you, my company uses our big old American Express card. We fund the loan, but what happens with an American Express card? You need to pay it off within a month, or you have some pretty significant penalties. Well, the same thing holds true for a warehouse line of credit. It's actually what caused a lot of the banks to implode back in 2008, but not because nobody would buy their loan. It's because of what's called buybacks. So in 2008, the investor said, hey, this loan isn't performing well. You have to write us a check to buy it back. Today, the investors are saying, we don't want to buy these non-qualified mortgages at all. Sprout Mortgage was trying to find a savior. They negotiated with Chase Bank last Wednesday morning. They were in negotiations with Chase Bank to give a significant loan to basically save Sprout Mortgage and get that $100 million of mortgages secured. And the deal fell apart. And the deal fell apart Wednesday morning, and by Wednesday afternoon, they shut down the entire company. Now, why does this matter? It matters because there were families who were in escrow to buy a home with Sprout Mortgage being the lender behind the scenes. Now, that doesn't mean that Sprout Mortgage was the company that your loan officer worked for. Sprout Mortgage was a company that was what's called a wholesaler. You had a broker who was starting that transaction and sending the loan to the wholesaler. None of those families were able to complete their transaction. The people who closed escrow on Tuesday were fine. The people who closed escrow Wednesday morning were fine. If you were doing a loan with Sprout Mortgage and your loan was supposed to close last week on Thursday, you did not get your home. You needed to go to a different bank and start over from the beginning, or your broker had to package up your file and send it to another bank to start over from the beginning. What that means is we're seeing Wall Street saying, we're not comfortable with fringe companies. We're not comfortable with fringe programs. Now, I think it's because Wall Street is looking forward and seeing a recession. Now, in a recession, unemployment spikes. Interest rates do not go up. Interest rates actually go down. We have housing prices do not drop in a recession, except for the 2008 recession, but that was caused by bad mortgages. But what happens in a recession is you have unemployment spiking. Now, mind you, if 10% of the population is unemployed, 90% of the population is employed. So this isn't a major crash in the economy. It's just a recession. I'm not saying that it's a good thing. It's certainly very painful for the people who are dealing with the job loss. But the reality is the mortgage space is going to get tighter and tighter. You have to be super careful with who you are working with, because there are large banks that you might think are stable, and they're pulling out of the mortgage space. Most mortgage companies are losing money right now. Loan Depot just rolled out their Vision 2025. Loan Depot is a super large mortgage company owned by a bank. Pretty sure they're owned by a bank. I might be wrong about that, but I'm pretty sure they're owned by a bank. Loan Depot said, we plan on being profitable in 2023. Well, that means that they're losing money right now. They're going to lay off, I think, 25% of their workforce before the end of 2022. That's part of the process when we grew so quickly and now we have to drop. But what does it mean? It means that you're going to have well-known mortgage companies that are going to be scaling back because they're beholden to shareholders and having to create shareholder return. They're part of a larger bank, and that bank is going to say, you know what, mortgages aren't making money right now. We're out. You need to be very cautious about what type of loan you're doing and who you're doing it with. Now, obviously, I'm going to take this chance to promote myself. I'd be stupid if I didn't. So here's the difference. Summit Funding is a privately held company, and we're extremely well capitalized. We have zero debt other than our leases. So we can survive a storm, and we have no other business line except mortgages. So it gives us the ultimate dedication to mortgages while still having the flexibility because we're not beholden to hitting a particular number that our parent company or that our shareholders require. That's what you need to be looking for when you're thinking of a mortgage company that you're going to work with. And obviously, you need to make sure that you have the right mortgage lender, the right loan officer to guide you through all of this. We're going to be seeing a lot more turmoil. The market is shrinking fast, and people are desperate right now to gain market share, and they're going to do that through throwing money at gaining market share. That can only last so long. You're going to see some companies out there that are going to offer deals that are way better than what anybody else can offer. They're trying to buy the business, but you can't sustain a non-profitable business. And that's the challenge we're heading into, is we're going to see mortgage companies disappearing at a very fast pace. We're going to see mortgage lenders leaving the industry and saying, I can't do it anymore, because this is a super challenging environment, and we're probably going to be in that environment for the next 12 months. So when you think about what's happening in the mortgage space, whether you're a realtor, whether you're in any other industry, just be aware. Things are changing significantly, and you need to make sure that you've got the right information from the right person. So subscribe to my channel. I'm going to continue to keep you updated on a regular basis. My YouTube channel is the best place to go. So subscribe to my channel. I'm going to give you all of this information and keep you informed, because things are continuing to change. We had an inflation report come out this morning that was higher than any inflation report had been in the past. We were at 8-something% last month, and everybody thought we had hit the peak. This morning, we ended up at 9.1% for the month of June. Based on the numbers I think it's going to continue to look bad until about October. So we've got a few more months of significant volatility, and probably 12 to 18 months before things start looking a little bit normal. But in the meantime, a lot of mortgage companies are going to fall out. A lot of transactions that are in process are going to fall apart. So just make sure that you're connecting with the right lender who has the right knowledge, and you're following what I'm telling you on a regular basis. If you have any questions, please feel free to comment. Let's take a look and see while I'm pulling up current comments. Next week on Business Booster, I'm going to talk about growing your business with HomeBot. So if you're a realtor and you aren't using HomeBot, you need to join. If you are using HomeBot, you need to join so I can show you how to use it better. So what have I got here? Joe says, great info, my friend. Appreciate it, Joe. I appreciate you. Thank you very much. Kathleen says, John's amazing. Anybody else who wants to talk about how awesome I am, feel free. I'm only partially kidding. Anyway, guys, if you have questions about what's happening in the mortgage world, post it in comments right now. If I'm still watching live, or if we're still live, then I will share the comment and answer your question. If it's after the live broadcast has ended here in a couple minutes, if I don't have more questions, I'm going to end the live broadcast. Then I'll get back to those comments afterwards. Thank you, Denise. I appreciate it. Guys, share this wherever you're watching this, whether it's on Facebook or YouTube. Press the share button and share it with everybody you know, and let them know, hey, things are really changing in the mortgage space. But here's the deal. It's still a great time to buy. And no, I'm not saying that because I'm a mortgage lender and that's how I get paid. I'm saying it's a great time to buy because we are in a short window of time where people who have a small down payment are going to be able to get an offer accepted. People who need down payment assistance are going to be able to negotiate with a seller. People who have a contingency to sell their current home are going to be able to negotiate and get that contingency done. The last 2 years, it hasn't been able to happen. In the next 2 years, it won't be able to happen either, because demand is down, but supply is not up. More news articles came out today about builders pulling back on new construction. They're slowing down land acquisition. It takes builders a year to a year and a half to build a home, and they're right now pressing the pause button on building. And I understand why. I've got some videos. I won't go too deep into it right now. But builders are slowing down their building, which means we're not creating more supply. The only reason why we have sellers that can't sell their home is because demand has come way down. And why did demand come down? 2 reasons. Interest rate went up significantly, and people are afraid that the market is going to collapse. Well, the interest rate going up significantly is a fact. There's a cool tool called the temporary buy down that you can link down below in my YouTube channel and learn about a temporary buy down. But the fact is, I don't see the market collapsing because there's still too many people needing a place to live and too few places for them to live at. So let's go back through comments and see if there's any other questions, and I'll let you guys go. Anita, thank you so much. Appreciate. Yes, we do need to get set up. Thank you very much. Appreciate that. And Kathleen, great information. Thank you, Kathleen. Guys, I appreciate you all today. Looking forward to seeing you this Friday. I've got my Financial Friday. I am starting a new series on my Financial Friday this week. And we're going to be talking about financial lessons we should have learned in school. And the first one I'm going to talk about is how to build credit. The truth is that between 18 and 22 is your best opportunity to build credit. Most people squander that opportunity. I'm going to teach you whether you need to learn that yourself because you're in that age group, whether you know somebody else that's in that age group. I'm going to teach you what it takes to actually act appropriately in that time frame of 18 to 24. It is the best time to build a great credit foundation. And then in the future on Fridays, I'm going to continue that series of financial lessons we should have been taught in school, talking about things like banking and just simply how banking works and checking versus savings versus money market accounts, all of those things that we don't know. And I'm also going to talk about things like automotive financing, buying a car versus leasing a car. What's a residual? How does this stuff work? The truth is, we as a society stink at teaching people the basics that they need to know about managing finances. And then it ends up coming across my desk with somebody that thinks, hey, I paid my rent on time for 10 years. That's all you should care about, right? There's a whole lot more I care about. So I'm committed to help teaching you and everybody that you care about those lessons that we didn't learn in school. So join me this Friday for that as well. Thanks, everybody.